G'day everyone. We've got Aslan, Brett and myself, Tony, joining you today. It's good to have your company. Welcome to 2021. Can you believe not only is it 2021 and thankfully not 2020, but it's already February. And as we look ahead into the year that's ahead of us, there is plenty to do. There always is on the financial front, but there's some really interesting things to be thinking about from a market, super and tax context before the end of the financial year. And we're going to be covering that in a fair bit of detail today. Brett, just in terms of what's happening in Adelaide at the moment, how's the new year sort of started out for you and the team there?
It's been great, Tony. We've had a bit more extended leave because of COVID in 2020 and people needing a bit of a break, but everyone's come back recharged. We've had a couple of great team meetings. Really looking forward to working out, particularly with the survey that we did last year with clients, to be able to work out what we can do better for them. So we've tweaked a few things and we're really keen on getting feedback from clients this year, and the team is they're refreshed and quite noisy and boisterous in the office, which is great.
Yeah, that's a nice thing. And it's always busy in Sydney, I suppose, isn't it? You know,
busy in a good way.
Yeah, busy in a good way. Yeah. But 2021, it's good to not be 2020, isn't it? To sort of actually look forward to something a bit more constructive.
A bit more positive, absolutely.
Yeah, definitely. So some really important end of financial year actions that we should be looking to now. And we'll be going through those today, and of course as well in a superannuation context. But folks, what we want to do first of all is just quickly give you an overview as to where we're going to go in our session today. And firstly, we're going to be talking about markets. Some interesting things going on out there at the moment. Not all of them necessarily make sense. So we're going to be covering those at a high level, what the investment committee thinks and what we think are the prospects for 2021. We're also going to be talking in some more detail with Brett and Aslan just in terms of those end of financial year actions for your taxes and your super. But before we start, and the obligatory warning, just remember that everything we talk about here in these sessions is general, not specific. It's not designed for you, doesn't consider your personal circumstances. Make sure that you get advice before you do anything. Straight to the top, we're just talking about 2021 in a market context. The good news is that the investment committee see conditions generally improving. Now, 2020 turned out to be a bit of a surprise year in a whole host of ways, but not least of which was that portfolios ended the year in approximately the same level of performance that they did a year earlier. In other words, fairly flat. Now, while that's not an achievement when we consider the backdrop around coronavirus and the shocks in the economy, it was actually a fairly good result. Most portfolios sort of ended up square. But as we look into 2021, we're actually looking fairly positively towards much better conditions for investment returns. Now, at a high level, the investment committee are focused on essentially four different things. Two of them are very near term and do have potentially a very significant impact on the portfolios in 2021, and two are probably a little bit more long dated, but I just want to introduce them to you because they get a lot of airtime but aren't necessarily considered to be market factors at the moment. Now, the first big thing that we're worried about at the moment, I suppose, and really looking for that signal as to an economic rebound and an improvement in the market sort of sentiment out there and the general economic sentiment, of course, is related to COVID. Now, with COVID at the moment, as we all know, there's been pretty significant improvement in conditions, specifically on the back of, I suppose, vaccines starting to come to the fore. Now, there's a whole host of vaccines that are out there, some of them well past phase 3, in fact, people being injected with them at the moment. But the most important thing is now the logistical challenge of actually getting those vaccines into the general population. Now, this isn't necessarily as straightforward as it sounds. Finding a vaccine we all thought was a miracle, but actually getting them into people is a big thing. And markets are going through this, if you like, rubber band exercise trying to work out when the timing is for when we reach herd immunity. Now, what you just saw there was based on current run rates, we would expect herd immunity to kind of arrive theoretically in terms of inoculation somewhere around about September this year. But if things happen to move more quickly, as you can see with these orange lines, it would potentially happen a lot sooner. And of course, a lot sooner would then translate into markets that in fact started to price in a much better prospect for the economy looking ahead much, much sooner. So the bottom line is the number one factor that's going to drive markets and market returns in the near term is of course going to be all about when will the impact of a coronavirus vaccine start to really kick in and when we start to see a general economic improvement. Our view is that you're going to start to see things in a broad sense start to kick in around August, September this year, which should make for a fairly strong end of year recovery. The second thing that we're also really concerned about, I suppose, is direction for interest rates. Now, I do talk about this one a lot, and you'll have to bear with me as to why, but the reason is that as interest rates remain low or go down, asset prices typically go up. The net of that is that for as long as interest rates remain low and government spending remains the way it is at the moment, be it JobKeeper or JobSeeker, you're going to see markets very well supported. In fact, we don't really see any change in those conditions in the first half of the year. And so the net result is markets are going to be well supported, interest rates remain low, government spending remains beyond epic, and that's all tremendously supportive for asset prices. So there, if you like, the two near-term factors are timing around COVID, and then secondly, what's going on with the direction for interest rates. Now, the medium-term prospect and something that captures a lot of interest, I suppose, from everyone who's an investor, of course, is what's going on with trade, and in particular, what's going on with the geopolitical environment. Now, of course, the geopolitical environment captures a lot of people's imagination in a trade sense because, of course, we've got the push and shove between Australia and China at the moment that's impacted our coal business. It's impacted the wine business, the cherry business, barley, lamb. There's a host of other industries that have been impacted. But what this is all about longer term is really what we're worried about, I suppose. And in an investment committee sense, we are concerned about the impact of this, but at the same time, we don't necessarily see the trade situation playing out in a binary fashion. In other words, we expect there will be a general pickup in the relationship between Australia and China as the year progresses, but at the same time, we have to remember that the geopolitical environment at the moment favours some of these bigger countries, be it China and the United States, and of course there's not always going to be an agreement. Code for saying it is on the medium-term horizon, it is a concern, but at the same time we think Australia's got enough time to work its way through to find other markets. So that's the third thing. The fourth thing I just want to introduce is a little bit more conceptual, is the era that we're now operating in a market sense is something that's sort of generally mirrored as well at a societal level as well. It's really about this misinformation distortion thing that's going on at the moment. Now, as many of us have sort of seen, disinformation and misinformation is something that was probably not that prevalent and we weren't thinking that much about, but it comes from many different corners, and this is causing market distortions in the sense that market prices are not really necessarily what they would normally be. Now, the first example of this, of course, is the epic amount of government support that's coming through. There is 20% more US dollars floating around in the economy now than there was a year ago. And that same distortion is being played out in things such as the issues we saw with the US elections only a couple of years ago. And that sort of mob mentality or the idea of disinformation is coming through in markets and through a few things recently like GameStop and also Bitcoin. Bottom line is, don't believe everything you read and don't necessarily believe a lot of the numbers that you see either unless they come from reputable sources and markets that are run in a transparent fashion. If we wrap all of that up, we, however, do see portfolios performing pretty well this year. We are optimistic about what's ahead, particularly in the first half. We see perhaps a pause in the middle of the year as that coronavirus vaccine starts to kick in. I was talking about herd immunity, maybe the middle to latter parts of this year, followed by hopefully much better and broader economic conditions. And on that last point, much more transparency in terms of what's going on in markets. We are favouring banks again. For those of you who are investors, banks are starting to look quite interesting in Australia. Dividends are expected to come back on stream. The impact from the COVID slowdown in terms of impairments and write-offs from loans has been reduced. And at the same time too, the businesses are in much stronger condition than they were a few years ago when so many regulatory concerns and headwinds were there. Bottom line, banks are looking interesting. Resources remain really interesting to us as well for, again, a host of reasons, but mainly an economic rebound. The bottom line is spending a lot more on commodities and hard assets. Copper and iron ore in particular are big players in the portfolios. Emerging markets are also a key focus for us as we see the decline in the US dollar. That chart I showed you just a moment ago, 20% more US dollars a year ago. In summary, that is good conditions for emerging markets and smaller economies, and we're starting to invest more heavily there. Lastly, smaller economies, be it in the United States or be it in Australia, they are great beneficiaries of the fiscal programs that are in place. And again, we are investing smaller in those sort of discrete or smaller businesses than we have been in the past, as again, the broader economy is expected to kick on. And lastly, a theme from all of last year, which is technology and the adjunct is healthcare, those remain in the portfolios as well. So that, folks, is the summary, is that we are expecting a much better year in 2021 than we had in 2020. Now, Brett, just to you, in terms of portfolios and what you're talking to clients about at the moment, sort of any tips or any thoughts on those things?
Look, Tony, it's always been a cash bucket approach for us. So when we're catching up and having reviews, we're just making sure they've got sufficient cash sitting inside their portfolio, but from where their payments are being made, and the people that are making contributions into super on a regular basis, being able to make sure that we're putting those things into more of the growth type assets so that we're taking into account the dollar cost averaging. Obviously, it's pretty choppy conditions, perhaps on the rise, but still choppy from day to day and week to week. And we can't time the market. So, it's imperative that we're putting money in on a regular basis, or when we're taking money out, we're not selling down shares on the week where they're down. So we've got to make sure we've got that cash sitting there. Yeah. All in all, though, Tony, clients are pretty comfortable. I think they've had more interest in the US election and China and those types of things, and are reading about Google and media and what is going to happen there. When the markets are doing reasonably well, the focus seems to be on other things, so which the testament to the clients, they actually understand the ups and downs of the share market.
Definitely. Now, Brett, moving on to the end of the financial year and some of the strategies we're just looking at, let's just talk about an e-book, as we call it, that we recently established, I suppose, or wrote and put together. This is late last year and it's only now being launched. But our e-book covers 15 different strategies for superannuation. Just tell us a little bit more about what's in it.
Look, the e-book, Tony, was more of it's on the website, and it's for people that perhaps don't have an advisor, or if they do have an advisor, one that doesn't necessarily discuss strategies with a client. And not all of the strategies are relevant to any particular person. But it's a nice little book that people can download and look at what they may be doing, and it may explain it in a format that makes them more aware and understanding of why they're doing what they're doing. But this is pretty much designed for people that are clients of ours. So feel free, as an existing client watching this, go and download it, not a problem at all, but we take these things into account. Perhaps where they might want to help their family and friends is to actually guide them to this ebook, so that if they don't have an advisor, at least if they've got a little 15-page document that talks every page about a strategy, it might make them a little bit more informed. And it's interesting when we chat with people, once you get to that 50 years of age, people start to wonder how many more years they've got ahead of them. And COVID was a wake-up call for people to think, wow, I might want to retire at 65, but I might get made redundant beforehand. What do I have in my super? And so these strategies are all designed to help maximise what you can get into super. And bearing in mind, superannuation is not an investment. It is just the way money is administered. The stuff that you talked about just before in relation to investments, that stuff is what makes your portfolio return great or return poorly. Superannuation is just a way that we can actually help people navigate their retirement. And so it's really important from that perspective. And there's some strategies in there that I really love.
Definitely. Well, Brett, what we might do today is just introduce a couple of these strategies, and I suppose the heads up here, folks, is that, of course, these are strategies, Brett, that the advisors, you and I, all of our team think about before we meet with our clients. But I suppose just a couple of insights here to a few of them, particularly ones that are end of financial year related as well. And Azzy, I'm going to bring you in on a few of these as well. But let's just start with the first one, which there are in the book actually 3 different government subsidised contributions. They're only small, but they can have large-scale returns. And of course, the one on your screen there is the Super Co-contribution. Just tell us a bit about this one.
Yeah, look, the book goes into the specifics, but in rough terms, if you're earning less than $40,000 a year and right up to $55,000 a year, and you make a personal contribution into super, now you are potentially eligible to receive a payment from the government of up to $500. So to get the maximum, if you are earning less than $40,000 a year, you make that $1,000 contribution. Let's say you're under 71, you meet the work test, you've got less than $1.6 million in super, then the government's going to give you $500. Now, that's right up until the age of 67. So if you're planning on retiring this year and you haven't made a contribution into super, it's just a free $500. You'd be mad not to take advantage of that.
Yeah, it's one of these many examples of distortions, as I call them, but it's free money at the end of the day. 1,000 in, the government gives you an extra $500. It's
50% return on your money.
Absolutely. And that's the way to look at it, really. At the end of the day, it's not a huge amount of work, but it's something that obviously can contribute to the longer-term superannuation situation for most people. Now, in terms of next strategies, Brett, and one that I'm going to bring Aslan in here on, is we have the recontribution strategy. Now, Az, I might get you to just quickly explain this, because this is one that does benefit from an accountant's perspective, but a recontribution strategy, what's that about?
So a recontribution strategy can also be known as a withdrawal recontribution strategy, Tony. And what that simply is when you withdraw an amount from super and recontribute it into your super fund, and it could be for various reasons. So the two primary reasons why we look at doing this strategy is one, for estate planning purposes. And by that I mean there is an element of minimizing the taxable component in your super fund, so that any non-tax dependents who receive your death benefits pay less tax or no tax on your super death benefits. The second reason is equalising super balances between spouses, and that's something that I think a lot of people forget about when they're in an SMSF together, and perhaps you had the wife in an SMSF who hasn't got as much of a super balance because she hasn't been in the workforce, she hasn't had the ability to contribute as much, and the withdrawal recontribution strategy is a really handy tool to equalise those super balances.
Definitely. Brett, it's a really important one, estate planning, but this particular strategy can save families thousands of dollars in tax, like very large sums of tax, can't it?
We use this strategy all the time, Tony, and look, unfortunately we get a lot of referrals for people that have been diagnosed with cancer and people that are terminal. It's just something that we've specialised in, based on certainly my history and some of the pro bono work that we do. But, when you've got subsequent marriages, you've got adult children, estate planning can be quite a difficult thing. And look, ultimately, the default for me is, unless you've got a partner, you shouldn't really die with money in superannuation because of the way that it is taxed upon your death. It's still favourable, but if you've got the opportunity, if you get the heads up, we're all going to die, unfortunately, but if you've got that opportunity where you are terminal, getting some advice to work out what is going to be the best tax consequence for you and your family. It could be that you do cash money out of superannuation. It could be that you're not sure that when you're going to die. You're not exactly terminal, but to be able to take money out of super and then recontribute it, so that the bucket that you've got there is less tax payable on it when you do ultimately pass. These are the really important things, and if they do, they can save tens of thousands of dollars.
Yeah, absolutely. It's well worth doing, folks. So that is a recontribution strategy. And Brett, something, again, with your team, I know, and with our team here in Sydney, it's something we talk about and consider all the time for clients. It has a massive "do not try this at home" sticker attached to it, though, because it can come with significant consequences if you make a hash of it. So please, if you're seeing this through a third party or someone's recommended that you do it, get advice. This is one, seriously, in this strategy book you really do need to get some advice on before you do it. But the flip side is, for families, it can save literally thousands of dollars. I can't think of too many strategies around tax that we know of that can be more powerful in an estate planning and a long-term context. So certainly, folks, one to have a look at. Now, the next one, Brett, just while you're talking, I might get you to just introduce this one for us. This is also a tax strategy, and this is a tax reduction strategy, potentially, but importantly, just a contribution strategy, as Aslan was talking about, carry forward concessional contributions. What's that involve?
It's a mouthful. Look, there's two ways people can put money into superannuation. It's either through their employer doing it on their behalf or salary sacrificing, or it's making a personal contribution into superannuation. And there's a difference between the two. This one does not focus on the personal contribution, and by that I mean there's no tax benefit of doing that. But in terms of the carry forward, money that you have put into super on your behalf, either by an employer or your own salary sacrifice, counts towards a cap, and everybody has a cap of $25,000 a year. The money that goes in as a concessional contribution is taxed at 15%, roughly, but people don't always use that cap up. And effective the 1st of July 2019, if you don't use that cap, it carries forward to the next year. So if you could have a situation where you've maximised the amount of money that you've put into superannuation at a personal level, and that's that $100,000 a year, but you can also potentially put in money as a concessional contribution of up to $25,000 a year, minus what you may have already done through your employer or through salary sacrifice. So the example in the ebook talks about being able to time the disposal of assets that are subject to capital gains. And so rather than have a spike in a particular year, being able to bring or use the carry forward and make a concessional contribution into super means that the amount of tax you will pay on what is assessable gets reduced. And again, it can save thousands of dollars.
Yeah, definitely. Yeah, Brett, again, another really powerful strategy, but as things I love here, don't I, tax and reducing taxes, if you have a very big transaction, if you have a capital gain of some magnitude and your balance is under 500,000, this is your super, and you haven't used up your 25,000s, then there is potentially the opportunity to do a very large offset against that capital gain using this particular rule.
Yeah, absolutely, Tony. And the really handy thing about this is that you can now see as an individual your cash-out contributions cap via MyGov.
Really?
Yeah.
I did not know that.
Yeah.
There you go. So MyGov, that's what it's for. No, just kidding. No, yeah. So it's on MyGov.
It's via MyGov, so you need to have the ATO linked to your MyGov account. And there's a section called My Super where it gives you all your information that you need for your individual super. So total super balance, bring forward arrangements, your catch-up contributions cap. Quite handy.
Actually, that's quite amazing. So there's actually captured a lot of information on MyGov. Now, just as an adjunct as well, for those who are thinking about this particular strategy, because I think this is a hugely, in the long run, there's potentially $125,000 worth of assessable income offsets, if you like, deductions, if you let this run long enough, if your super balance is low enough, if you haven't been contributing. Again, folks, as I've said a few times, this has got a big do not try this at home sticker attached to it, okay, so get some advice on it. But conceivably, in the long run, this is potentially a very attractive opportunity for people to manage a large capital gains tax bill.
Yeah, absolutely. I do want to urge that this is something that you need to seek advice on. Yeah. From your advisor and accountant, because when we're talking about a big capital gains tax bill, the amount of contributions that you would need to put in to reduce that, claim a deduction off your contributions, we may be going into territory where you're over contributing, which may have penalties or excess contributions tax that we want to avoid.
Always a sensible one in the red, Aslan. Absolutely. So folks, do heed that warning and make sure you get advice on that. All right, so just to segue there, why don't we keep going as we're going to talk about the end of financial year and getting yourself tax ready for that. Now, we have only got less than 6 months to go, in fact less than 5 months to go until the end of the financial year, and quite a few of these strategies require a bit of runway or a bit of lead time to get them organised, don't they? So why don't we just start on the superannuation and individual side of things. We have pensions. What goes on there?
Pensions, it's always my favourite, and I can't stress this enough. So we saw that the government have reduced the minimum pension drawdown requirements by 50% last financial year. 30 June 2020, and that's been extended for this financial year. So even though your minimum pensions have halved, it does mean that you still need to take that reduced minimum requirement to meet your minimum pensions.
Okay, and contributions to super as well?
Yeah, so I think Brett gave us a lot of background on how there is additional contributions of availability into super. So he spoke about the co-contributions, your catch-up contributions, and I also wanted to flag that we have seen the work test exemption been extended for those aged 65 and 66. And that came into play this financial year, 1 July 2020. So if you're a retiree, you're over the age of 65 and it's before your 67th birthday, you do have the eligibility to contribute personal contributions to your super fund.
Definitely.
Yeah.
And I think that's a really important one. I was going to bring you in on that one, Brett. That's a really important one to think about, isn't it? Is that change, although it's subtle, is actually quite a big one in terms of people's ability to do a bit of tax planning. You might be retired, you might be 65, but the door is back open again.
It's absolutely massive, Tony, and this is one of the reasons you need this ongoing relationship, because the rules are always changing. There's a budget every year. I've been consider what the budget looks like this year. Potentially we're in an election year, who knows, but there are always little minor changes, or you might actually miss them if you blink, but they can have such big impacts on the right type of person. And when you've got a relationship with an advisor, we know this stuff. So even though you may not completely understand what we're talking about in a review, the fact of the matter is that under the surface, we've already considered many of these things, and we're asking you questions to see whether there might be an appropriate new strategy to your circumstances.
Definitely. And as just keeping on that slide there as well, we also have, of course, the valuation of unlisted assets. Now, that, I suppose, is reference to property for most people, isn't it?
So for most SMSF trustees, the main and most popular unlisted asset you would have in your super fund is property. And because we've had such a tumultuous year in 2020, I think many trustees may have seen the value of their SMSF property taken dips and peaks, and it may be a good idea to revisit your revaluation of that property, because that could benefit you when determining your total superannuation balance. And it might open up the door again to make further non-concessional contributions, which you were previously locked out of because your total super balance was over your 1.6 million cap.
All right, and the last one here, important, there's a great article on our website, on our blog page, about working from home deductions and also the income tax cuts from Riyadi Aslan. But what's the summary there? You can get a deduction for working from home.
Oh, absolutely, and we've seen that in 2020, where more people were starting to claim their work from home deductions. The ATO have released a simplified method of claiming your running costs for working from home, and that method can be used again for this financial year in your 2021 taxes.
Okay, fantastic. Now, as on the business and trust side of things, of course, we've got JobKeeper. That continues at least until March. I know there's a lot of chatter out there about March.
Yeah, so we'll see JobKeeper end in March, and it has been such a huge help to businesses, particularly our small businesses, in supporting them. And you will see, if you are currently on JobKeeper, that if you claimed any payments in FY 2020, this is still accessible income to you as a business. I do want to remind our businesses that we need to be reporting your JobKeeper payments in your tax return. And just a reminder that when you're claiming for the January, February, March year, you will have the lower payments of up to $1,000 a fortnight.
Okay. Now, a few other things to take advantage of. Instant asset write-off. How does that work?
Yeah, so we spoke about this in the October budget webinar, Tony, and I wanted to remind our businesses that that instant asset write-off is eligible up till the 2022 financial year. And this is huge because it means that most businesses can claim up to the full value of an asset. The full value meaning there is no threshold. Previously, we saw that asset threshold at $150,000. Now you can immediately expense the value of that asset in a certain financial year.
Oh, fantastic. Now, the second last one here is a mind bender. The carry back tax losses. Please explain.
This is another October budget special that we saw come out a few months ago, and what it essentially is that a business can use its current year's tax losses and have these losses offset previous tax paid. So, for example, let's do an example, Tony. 2019, a business made a profit.
Yep.
A company made a profit, I apologise, it should be companies. A company made a profit, we pay tax on that profit. Your 2019 tax liability can be used and claimed as an offset in your 2020 tax return.
Okay, and this is a special, but in summary, as I understand it, if my company made $30,000 in profit, I owe $10,000 in tax, this is 2019.
Yep.
That $10,000 in tax can be used against any profit that I make in 2020.
Against any losses I hold, yeah.
Okay, so the bottom line is one offsets the other in a backward-looking fashion,
Correct.
not a forward-looking fashion,
Correct.
which is how the tax system normally works.
Yeah, absolutely. So you're effectively averaging your tax payable over a 3-4 year time period.
Yeah, and I think actually there's some tax planning opportunities for businesses. I know you're talking to your clients about that, but for anyone who's watching small business, you should really get some advice on this one because there arguably may be some planning opportunities.
Oh, absolutely, and it's a curly one to get your head around, so it's something that you're welcome to give us a call about.
Yeah. No, I'm just watching Brett. You're looking perplexed as well as I was too. Yeah, that's exactly what I thought. Never heard of it. It sounds a bit curly. It's a bit COVID. That one, isn't it? Definitely. All right. Just the last one here as trust distributions. Trusts have to distribute their income every year. That is how a trust works. What about this year?
Yeah, the same as this year. So it's just a reminder to the trustees of discretionary trusts to have your trustee resolutions signed and dated by the 30th of June, and this is when you're making a resolution to distribute income to your beneficiaries.
Definitely.
Yeah.
All right. Now, folks, that has been quite a mouthful in terms of different things to think about, and bear in mind that it's actually one of probably 24 different tax strategies that are available to you before the end of the financial year. But if I was just going to summarise, as critical as the payment of pensions for SMSFs that are in pension phase, that is so important, that one. The second one is to maximise contributions to super, the concessional ones, tax deductible. If you've got a smaller super balance, as we were talking about there with Brett, there's this great strategy to use and roll up a bunch of them if you've had a capital gain or a good year. The other thing to just make sure that you do is just the hygiene, is tax planning. Talk to your tax agent, talk to Aslan, talk to Brett, talk to the advisors. There are always opportunities to just think about things before the end of the financial year. And the last one, Brett, which I'm just going to get you to come back to me on again, is just around estate planning. You know, it is so important. That recontribution strategy can save families significant sums of money in the long run.
You can, Tony. Look, there are so many things when it comes to facing your own death, and you don't think straight, and you need to go and see somebody, and you can't go and get your estate sorted before you pass. That's the whole idea of having the executor. But you talk about tax planning, we talk about retirement planning. To some extent, there's death planning in all this as well, and it's a pretty morbid conversation, but it happens to us all, and it's when you don't get the plan for it. We deal with the stuff that's left behind when people come and see us, and it's really important because ultimately you want to pass on to your next generation the maximum you can possibly do. But it also gives you a bit of peace of comfort as well, because there's so many other stresses going on in people's lives, and whether you're 1 year away, whether you're 30 or 40 years away from passing, it's just nice to have that understanding that everything's been sorted out.
Definitely. Brett, I'm just putting the slide up here. Of course, we have lots of information and an article you wrote on precisely that issue on the blog last year as well. And people do keep in touch with that or keep an eye on it. I know that we send you emails every couple of weeks with new stories and things that we get really excited about. But there's some really interesting and useful ideas in there, including, as you were just talking about, Brett, making sure that you've thought through various estate planning issues well before, things happen.
It's interesting, Tony, that there's probably not too much that we haven't discussed with clients. And so people are sitting at home watching this thinking, my situation is unique. Nobody thinks like me. Nobody has the same circumstances as me. Well, it's probably not true. And a problem shared is a problem halved. And having that conversation with us, we're not mind readers. We've got our own stuff that we want to make sure that we're doing for you on an annual basis. But in between our catch-ups, if something happens and you think you don't know what the answer is going to be, give us a call. And if something happens to your circle of friends, direct them our way. It's we're going to be able to help one way or another.
Definitely. And another very important one that's coming up in a couple of weeks' time, and something I just want to draw you on a little bit more, just tell us, we're going to be running an event for International Women's Day.
Yeah, that's right. So International Women's Day is the 8th of March, Tony, and I'm looking forward to chatting with two of our Adelaide advisors, Tracy and Renee, and the three of us will be, sharing our experiences as women in finance roles.
Yeah, definitely. It's something to watch out for, folks. One of the things that we don't often get the opportunity to really talk about as our team members and the things that they do, not just for our clients, but for all of us as team members as well. And Brett, given that more than 80% of our team in Sydney and Adelaide are, of course, women, and they do an amazing job for our clients. I think it's tremendously important and a great initiative as just to be sort of talking about that. And of course, Brett, two female advisors you have in Adelaide, Tracy, Renee, fabulous operators. You've actually had Tracy as well on one of the videos that we've done in the past also.
Tony, you and I are both very, very lucky to be surrounded by three exceptional women. And I would trust all three of them with my mother. And my mother can be a handful. I hope she's not watching this. But it's a testament.
We'll just rewind the tape there a little bit, just in case.
Sorry, Mum. No, absolutely. So critical, and as looking forward to seeing you and Tracy and Renee having a chat and do so many good things for our clients. Around the 8th of March, we'll have that pre-recorded and distributed as well. All right. Well, folks, last thing to say, I suppose, is it is the start of a new year. It is a great opportunity to kind of clear the decks. I know a lot of clients have spent a lot of time at home over the past 12 months, been very disciplined in getting those tax returns to us early this year, had a bit more time than usual,
Thank you for that.
And Brett, been a bit more engaged than usual, so we appreciate that. But let's keep that momentum going and get to the task before the end of the financial year. I suppose, Brett, we're probably all hoping, in fact, we should expect a much better and more stable 2021 than 2020, do you think?
Look, I hope so. It depends on what the state premiers do when they get a positive COVID test. It probably hasn't started the way that we hoped, but let's hope the vaccine rolls out through the country. Let's hope my mother talks to me again. There's so many things to look forward to in 2021.
Definitely, and from an investment perspective, it just statistically, folks, it just will be a much better year. So thank you very much for your time, everyone. Great to have your company. Of course, you can see this if you miss bits of it or rewind the tape, as it were, in the old days, up on the website. It'll be there for some time to come. Of course, any questions that you have at all, give us a yell. And of course, if anything caught you unawares and you wanted to have a bit more of a chat about any of the strategies, remember that everything we've discussed here is general, not specific to you. Therefore, you do need to get advice. We look forward to seeing you all again very, very soon. Bye for now.